Thanks for joining us today on The Close. I'm Marilla Fernandez. Markets close in half hour's time. Let's get to the stories we're following in the BNN Bloomberg newsroom. Cogeco Communications, one of the biggest laggards today on the TSX, after La Caisse says it intends to sell part of its stake in the company. The 11% stake will generate around $229 million. The company is rebalancing. La Caisse says it continues to have confidence in Cogeco and its direction. The funds from the sale will also be used to support and grow Quebec companies. Metro also a decliner today on the TSX. The grocery chain posted lower profit in its first quarter, weighed down by the temporary closure of its Toronto frozen food distribution center. Sales from Christmas Eve are now going to be accounted for in the second quarter. That's a change. On the upside, revenue rose more than 3%, with growth in same-store food and pharmacy sales. Shares of UPS are moving higher today after the shipping giant forecast full-year sales that came in above the estimates of Wall Street. The company now projects nearly $90 billion in revenue this year, marking the first time in a year the courier has provided a full-year sales outlook. UPS is carrying out a new profit-boosting plan, which saw it cut deliveries for its largest customer, Amazon. Shares of United Health plunging. The healthcare giant is forecasting a decline in 2026 revenue, marking the first annual contraction in more than 3 decades. The U.S. plan to hold payments flat for private Medicare is adding pressure on the insurer. United Health is also shedding insurance membership, divesting overseas assets, and shrinking its American footprint in some areas. Let's have a look at where the markets stand right now. Not a monumental change for the TSX. It's dropped 11 points right now to 33.81. The S&P 500 up today about 33 points, or almost half of 1%. The Dow Jones has a 429-point drop, or 0.9%, and the Nasdaq itself 241 points up, over 1%. Precious metal still seeing new highs in the market. Let's go to David Burrows on this. He's CEO and CIO of Barometer Capital Management. David, thanks for joining us today.
Great to be here.
So gold closing in on $5,100 an ounce. What's your take on the run for precious metals for 2026?
You know, it's interesting. Really, the gold and the silver started rallying almost 2 years ago. And it's funny how, at this point, lots of press and lots of focus. The truth is that precious metals bull markets tend to go on a long time. When precious metals start outperforming indices like the S&P, historically, it can go on for 8 or 9 years. Having said that, in some ways, if you look at, for instance, the price of silver, it is going a little bit parabolic here. The chart has become a little bit gappy. There's obviously a short squeeze going on. And so when we look at this, we have to pull the lens back and say, okay, look, the long-term picture is both gold and silver look like they're going higher, and certainly the producers you would expect to go along with it. In the near term, I do think that we are getting stretched, relative to the longer-term moving averages. If you look at the bull market in the 70s, silver got to about 230 or 240% above the 200 weeks moving average. And as we sit today, we're closing in on 300% above. So, things are getting stretched by a little bit. And I think that people have to be a little bit careful. Easily, we could see a 25 or 30% correction. But having said that, if you have an iron stomach, which I don't, likely there will be 2 or 3 legs of this bull market, and it'll go on a long time. So in the short run, a little bit overcooked. Longer term, probably still a very good opportunity. Very few people are invested. Most people have watched this go on from the sidelines.
Okay, and you are saying that kind of correction for silver alone. What about gold?
Yeah, I think that gold probably also corrects. they tend to move in tandem. Gold goes first, silver goes second. I think there's more speculation around silver, and there's probably more of a short squeeze in silver. If you're going to be there, my suggestion at this point is you probably want to be in the senior producers, and you might want to take some profits on some of the juniors. Not to say they can't go farther, but in a reversal, if the seniors pull back 25 or 30, the juniors could pull back 40 or 50, and I'm not sure many people have a stomach for that.
Okay, let's get to some earnings. We had the grocer Metro reporting and a loss there. They're calling it a challenging environment for 2025. Was there anything out of the ordinary that fed into this?
No, I think that people look at Metro and compare it to Loblaws, and Metro's done a very good job, but really they are less consistent than Loblaws is. And frankly, if you look at the sort of consumer staples sector, this has not been a leading sector in the market. And so I'm not sure they're getting much of a tailwind from the sector. So we're just a little bit cautious, and we have not been focused in the defensive sectors because, frankly, it's the economically sensitive sectors that are really performing, especially, as a follow through from 2025 into the first month of 26. The market is rotating towards cyclical stocks. And so, Metro, not the number one stock in the group, the sector, not the number one sector in the market, just probably less flows than you're seeing in other areas.
Okay, I should have mentioned this after gold with the run up in gold, but the U.S. dollar is still sliding now into a fourth day. Big picture, is that just sort of big picture driving it, sort of the geopolitical uncertainty, Donald Trump tariff threats, that kind of thing?
Yeah, I think actually the biggest story right now in the market is the U.S. dollar. Over the last 15 years, while international stocks really underperformed, they had no return for over a decade. And while the U.S. dollar was rallying against virtually every world currency, global investors outside the U.S., bought dollars and got a carry on the dollar going higher, took those dollars and bought U.S. Treasury bonds and bought U.S. stocks, because it was the only game in town. And, after 15 years of doing that, they're probably maximum long U.S. stocks. And at this point, we now have the dollar weakening against virtually every major currency. It is not just pulled back, it's broken sort of all of the support. And so with a weaker dollar and much stronger international stock markets, there is incentive, first, not to put more money in the U.S., and second, probably to repatriate some to home markets. And international stocks are a lot cheaper than U.S. stocks. They are not well owned. And so I think all of our jobs is to try to get in front of these big structural changes. And this is where there's, I think, great opportunity for this year and going forward. Probably international stocks outperform for the next several years. Okay,
so along those lines, you have one or two picks you like?
Yeah, I think one of the areas that does well when there is an elevated inflation risk, and you can see that long-term bond yields have been sticky and staying higher while short rates are going down. That tells you bond investors think there's going to be a little more inflation. The materials sector, which of course has been a champion in the month of January, following through from what happened in 2025. And there's some great global players there. A great way to participate in multiple commodities is Rio Tinto. It's a very well diversified commodities producer. And over time, they have a history of paying special dividends. And we're seeing the price of copper rally. We're seeing, of course, the price of nickel rally. We're seeing, of course, gold and silver. And some of these companies are going to be great dividend growers over the next number of years with really strong international assets.
Okay, I do have to leave it there. I'm out of time with you, David, but thank you for your time. Appreciate it.
Thanks for having me.
Coming up, General Motors shares jumping after a strong profit forecast and a new buyback. We'll talk about those earnings when we come back. General Motors delivered an outlook that topped Wall Street expectations and announced a new share buyback program worth $6 billion U.S. Now, to walk us through the details, we sat down with Tom Narayan, lead equity analyst, global autos at RBC Capital Market.
I think a lot of the expectations in autos is a lot of fear and anxiety on this year. So I think some of the commentary that we learned from the conference call and the results kind of alleviated a lot of fears. 16 million US SAR, that's not like auto sales falling off or anything. They said pricing would be flat to up. That's a healthy signal. The big story is on EVs, right? We're all seeing this EV slowdown happen, but GM is showing that it actually could be a beneficiary here. It built its EV plants to be flexible, and it can actually just switch production to make ICEs, internal combustion engine cars, from EVs, and it's actually expecting EV losses to come down next year. And then tariffs, there's a potential that that could be better next year if USMCA gets resolved. So when people look at the numbers, you actually see the EBIT, or their profits, actually increasing next year versus this year. People did expect that, but now we have more confidence. And then, of course, you have that $6 billion buyback. So I think it's more of a confidence-building messaging as opposed to kind of hitting it out of the park. A lot of people had a lot of fear and anxiety, and I think people feel a little better.
Any concerns about a lot of their profit came from the big ones, like the Escalade, things like that? Any worries that those might drop off, those sales?
No, actually, if you look at what's happening, you guys know this really well. The strength of the U.S. economy is happening kind of at the top end, right? The troubles, so to speak, are kind of happening at the lower end. And if you're GM, you have 65, 75% market share of the large SUV and pickup truck market. That's a dominant market share position. That's like a juicy high-end consumer. That part of the economy is actually pretty healthy, pretty strong. And the other thing we want to note is, the car is not really a consumer discretionary expense in the U.S. Unemployment is very low, right? If you have a job, you're going to buy the car. You have to get to work. I think that's something that a lot of people are seeing high car prices and they're worrying a little bit, but that's just the reality. The meat and potatoes, the higher end consumer of the U.S. is still fairly strong, especially when it comes to buying something like a car.
And ambitious from the president of GM, or was it the CEO who said it? They hope to catch Ford in production.
Yeah, I mean, you have, they still view the economy as very healthy. The volumes they're saying are flattish. You're coming off of they were able to get pricing, whereas other companies did not. A lot of it is new model year coming in. So, why not take advantage of that strength of the economy, keep on selling, keep on producing? There was this narrative that maybe they were going to produce less, right, and focus on the higher end vehicles to get, higher profit margins, but then that means lower volumes. But that's not what's happening. They see the strength and the health of the economy, and they're taking advantage of it.
And any potential headwinds? I mean, they've gotten away from EVs, but is there the possibility that may again become the future? What if the government changes and the next government says, no, you got to bring EVs back in?
Yeah, and I think they're very well positioned in this regard. Their plants are very flexible, right? So, for example, the Orion plant, they're able to just switch from making EVs to make ICEs, in the same kind of factory, same labor, et cetera. They're able to do that at Ramos in Mexico, where they make some of their EVs, the Equinox and Blazer. They also make ICEs there, so they can just switch. So it's not really as big of a concern. They're able to be nimble. If that does happen, and we do think it will happen, EVs aren't going away forever. It's just there's a big delay. There's a new administration, et cetera. They're able to pivot and produce more because of the way they built a flexible architecture. I think that's the key here for GM.
And with the hybrids, what are they doing there with that? I know that was people were talking about that as a potential short-term future for cars.
Yeah, that's true, and that's something that certainly could be a pivot. Ford's talked about that pivot to hybrids. Certainly something here, but I think here the story is more ICE lasting for longer, right, and then eventually pivoting to EVs, full electrics. I still think that's what they want to do. They talked today on the conference call about different battery chemistries, LMR, LFP. What does that mean? That means lower priced, lower cost batteries. Ultimately, one of the big problems why there's an EV slowdown is they cost too much, right, for consumers. If you can bring down the cost to make the EV, then that makes it more advantageous. Also, the charging infrastructure needs to get better. So I don't know about hybrids. I think for GM, it's more about their ICE and their bread and butter, and then in the future, pivoting towards full electrics.
Tom Narayan is lead equity analyst, global autos at RBC Capital Markets. We are looking ahead to the Bank of Canada announcement tomorrow. Our next guest says it's not so much about the numbers, but the messaging. Back in a moment. Most economists expect the Bank of Canada to keep the interest rate unchanged, but it is the messaging around that will be watched closely. Let's bring in Pierre-Benoit Gauthier. He's Assistant Vice President, Investment Strategy at IG Wealth Management. Thanks for your time.
Always happy to be here.
So the latest inflation report, as you know, was affected by that GST holiday we had, Christmas of 2024. Is there any value in that metric at all?
Well, right now, the inflation numbers are actually quite close to the objective, right? We can argue about decimals, but really, in the end, inflation appears under control in Canada. So tomorrow, what's going to be interesting is to see if the Bank of Canada agrees with me or not. Are they going to see inflation picking up ahead? Because there are reasons to believe that we could face future inflation. For example, the price of materials, a very strong economy down south. So all of this could surprise to the upside inflation, and they could have a messaging that's very cautious. On the other end, maybe they'll be more concerned about the strength of the Canadian economy, of employment, and probably also a new concern to them is the state of the Canadian dollar. The U.S. dollar has been losing a lot of value in the last few days, so that's also going to be a concern for them, because while the U.S. On the U.S. side, the Fed is very concerned with full employment and inflation. In Canada, there's also the notion of currency, without calling it control, currency protection. So tomorrow the messaging will make it clearer which of these priorities is the main priority for the Bank of Canada. Okay,
the unemployment rate did tick up, as you know. So how heavily do you think that'll weigh on any decision here?
Well, at some point, that's what's going to be the tipping point for the Bank of Canada, right, to make it a priority. Last time I was here, we were mentioning that expectations for rates in Canada was actually to go up in 2026. So the markets were pricing in a hike in Canada and pricing in cuts in the U.S. Back then, we were saying that this felt extremely unlikely to us, as it would be too detrimental to the Canadian dollar. And now we are seeing the markets go in that direction too, meaning that hike expectations in Canada still exist, but they are much lower than just 1 month ago, while in the US, the odds of cuts for the whole year are also toning down. So we are meeting halfway, and that shows us that at first, everything seemed to be focused on inflation, and now the bank appears to be more concerned about employment. And I think that is very wise of them if they are moving that way. There is a lot of potential in this economy, and rates right now, while still overall neutral, could definitely help more.
Okay, what do you think, if anything, could shift expectations for the Bank of Canada rate cuts this year as we move forward? What do you think could change their mind? Some drastic tariff decision, perhaps, by the U.S.?
Of course, yeah. That has got to be on their mind, and we have seen that trade worries last year were very much overblown, and now the market, I wouldn't call it complacent, but the market has kind of moved past it, right? But in the real economy, the effects can be seen in some places. So it doesn't mean because the TSX is doing great that the whole of the Canadian economy is doing great, right? So the bank is looking at this. Also, the state of the U.S. dollar is again is going to be is going to help them, because if the U.S. dollar weakens a lot, then it gives them a little more wiggle room, a little more breathing room to cut rates. When the Canadian dollar is very weak, if they were to cut more than the U.S., it makes it too weak, and now inflation is dangerous. So it's a very tight rope they are on, but the current state of the economy and the current state of the dollar makes it like they could surprise us and be a little more dovish than last time, hopefully.
Okay, let's talk a little bit about the tone, because with the expectation for the rate sort of not moving, many people are going to look at the messaging. The messaging last time is, we are where we are. It's quite likely we're going to stay here. So do you expect that same messaging to be delivered tomorrow?
Yeah, there's much less, let's call it, pressure from the political side in Canada on the monetary side for being more dovish and more accommodating than down south. So I think that culturally, the Bank of Canada is always happy to be a little more hawkish and at least neutral, right? So we shouldn't expect them to be extremely dovish either. But anything that even looks like an open mind for eventual cut will be seen as a good news, because right now there's not a lot of things pointing towards cut expectations in 2026. So the slightest wording will be taken with great hope by the markets.
I'm sure it will. Pierre-Benoit Gauthier, I will leave it there. Pierre is Assistant Vice President, Investment Strategy, IG Wealth Management. All right, let's have a quick look at the markets before the end of the trading day. The TSX, not a material move today. It's 25 points down to 33.67. Let's move to the U.S. and check it out there. The S&P 500 has a 29-point gain. So on the flip side, and the Dow Jones, a 399 400-point down today. It's a 0.8 of 1%. The Nasdaq, a 218-point gain. So a very mixed day. The closing numbers are coming up. Stay tuned for that. Here are the closing bells for the end of the trading day. At the Nasdaq, Lexicon Pharmaceuticals ringing the bell. In New York, it's high-tech delegation to the March of the Living ringing the bell. You're watching the close on BNN Bloomberg. I'm Marella Fernandez. Here's how we ended the day on Bay Street and Wall Street. The TSX today, just a 3-point move up, so not a big move for the TSX. The S&P, a 20-point move up today. And then the Nasdaq, a 215-point gain, almost 1% up. Let's get to some of the movers in Toronto. We're going to start with Novo Gold. Novo Gold is up 11.5%, or $1.64, taking the stock price of $15.96. Moving to MDA Space, also a gainer today. It's up 6.5%, or $2.37, after signing a deal with a Korean aerospace company. Celestica gaining as well today. It moved up over 7%. That's a gain of $29.80 a share, taking Celestica to $452.26. And that company, by the way, reports tomorrow. TransAlta also gaining today over 6%. And then in the red, Metro, which reported earnings today. Investors clearly didn't like it, sending shares down more than 5%, almost 5.5%, a loss of $5.39 per share for Metro. And then Cogeco also down today on some news. It's down almost 6% of $4.26 a share going for Cogeco. We also want to show you the American dollar, which has hit a 4-year low. And Donald Trump had something to say about this. He said he's not too concerned with the decline of the dollar. He says he doesn't think the dollar declined too much, and you can have it up or down like a yo-yo. All right, let's go to some of the details for the movers in Toronto. Bloomberg's equities reporter Stephanie Hughes joins us now with that. Stephanie, what's going on with AGF? Shares moved today. Last time I looked, up over 6%.
Yeah, that's right, Marella. In fact, they hit a peak of nearly 8% of a gain at their highest point today, and that's contributing to an ongoing rally that started late last year that brought the stock price to its highest level since July 2011. And that's because, so it's been nearly 15 years since we've seen the stock price actually trade at this level, which is pretty impressive. And that's because the investment manager's EBITDA, or earnings before interest, taxes, and other adjustments, came well ahead of what analysts were expecting. So there's also quite a bit of earnings per share strength compared to a year ago. Analysts are broadly saying that this is thanks to some massive gains in the AGF Capital Partners business, and that the mutual fund flows of $276 million really just blasted past expectations. Jefferies analyst John Aiken and his team said that they believe this actually really underscores the value of the business, but it hasn't been fully reflected in the valuation yet, which is pretty incredible. So AGF's share price is actually a far cry from its peak back in 2007. But it has been on a slow crawl upward since late last year, and developments like this are really adding to that progress, Marella.
Okay, let's also get to Metro. We talked about how it reported earnings today and admitted 2025, of course, was challenging for the company. What else did they share?
Yeah, that's right. So from one earnings report to another, Metro having a bit of a rougher day today. Those shares fell by nearly 8% at its lowest point, which marked its biggest intraday decline since November 2023. It spent most of the day as one of the worst performing stocks on the TSX and dragged the share price down to October levels. That's because Metro, the grocery store chain, its first quarter earnings fell short of what analysts were expecting. We had some input from people like Scotiabank analyst John Zamparo, who said that most of the miss was driven by depreciation, taxes, tax rates and interest, and other issues that kind of weighed on the results. But he also added that the expected softer same-store sales growth and gross margins are probably what investors are going to be focusing on the most, and you could probably see that reflected in the share price. That, and management also commented that they're dealing with a challenging economic environment that's weighing on the outlook. So that's contributing to investor fears that they're just navigating a more competitive environment, and also with the higher square footage growth. Given the headline miss, even before the market open, analysts said that they were expecting some softness in the share price. And Marella, that's exactly what we saw today.
All right. Want to keep an eye on Bloomberg. Stephanie Hughes reporting there. Thank you for that. Let's go south of the border. Bloomberg senior equities reporter Bailey Lipschultz joining us there. Bailey, let's start with Corning moving up. They aim to deal with Meta for fiber optic cables. How big is the deal?
It's a big deal worth, according to CNBC, about $6 billion. And when you look at the stock price movement, the company having its best day in about 21 years the last time I looked at a terminal. So a big rally for the company, which was the best performer in the S&P 500. So obviously, when you look through kind of the back and forth that they gave from a management perspective with CNBC, talking about the fact that they expect to see a lot of demand from these data centers. So Meta, think of others that are rapidly investing in data centers, building them out, and also powering them. As you can see, investors are looking for other companies and other ways to play the AI theme, and it does seem like Corning now has joined kind of that group of companies making those picks and shovels that will actually benefit from just the spending. Obviously, the big question is what's the ROI for the likes of Meta and others who are investing tens of billions of dollars? Well, if you're buying Corning, it doesn't really matter if you're going to ink a deal of this size and magnitude. certainly going to be interesting what the company reports tomorrow with earnings. But as you can see, a pretty breathtaking rally over the last 18 months.
Okay, let's get to Cloudflare as well. It's doing well with its AI assistant, I guess. So what happened?
Yeah, it's doing well with its Claude bot. So different than Anthropic's Claude, which has shaken up the software space entirely. But it really is a bet on the security that the company can overlay with some of those large language models. We saw a number of analysts kind of pounding the table with the potential for AI to be a boon for Cloudflare. As you can see, big rally today, but still nowhere near those peaks that they saw in late October, just given the pressure we've seen, broadly speaking, from software. Cloudflare fits right at the middle of that debate of cybersecurity versus software and what that actually means in a world where something like Anthropic's Cloud bot can kind of change the entire way that these companies operate and bill. Again, if you look at today's move, it does seem to be driven by the optimism that the company can coexist and actually thrive with the uptake of the likes of Claude and others. The big question in the grand scheme, though, will be how do these applications interact and how do they integrate and what do other competitors have? But as you can see by this price movement, bullish today, but pretty weak, all things considered, looking back since late October.
Okay, let's get to Micron. It broke ground on a new facility, and so it's doing well today.
Yeah, doing well today. The company working to open up a facility to build out operations in Singapore, so earmarking $24 billion for that. The big takeaway from the sell-side analysts is that this is another signal that the memory demand boon that we've been seeing for the last few weeks and months is going to be here to stay, just because the company, again, is investing more than $20 billion to beef up and build out that facility in Singapore, build out capacity. It is a 10-year project. Yes, they can start producing memory chips in a few years from this facility, but it is a long-tail bet that memory chip is going to be a robust market, and that this is actually going to be an area that there still will be limits to the supply. And as we've seen really playing out over the last few weeks, last few months in particular, a lot of investor demand in companies that are producing these chips. That's led to the likes of SanDisk and others to rally so far to start the year. But as you can see, Micron benefiting today on that facility. Also probably doesn't hurt that they're expanding and beefing that up in Singapore. So diversifying supply chain, diversifying offerings, at least from not only a company perspective, but also a country perspective.
All right, Bailey Lipschultz, thanks for the update. Appreciate it. Coming up next, we're having a look at areas of opportunity in the markets and what the word of the day is, according to our next guest. Back in a moment. Our next guest says the word of the day is Goldilocks. Let's go to Jimmy Lee, CEO of Wealth Consulting Group. He joins us now. Thanks for your time.
Hi, good afternoon.
So Goldilocks implies, of course, that there is a balance. Everything is just right. But consumer sentiment is very weak in the U.S. So does that fit the narrative?
It actually does. We think that, consumer sentiment being bad, which it has been for a long time now, is actually positive if you're bullish on equities. And so we think that, that contributes to why there's so much cash on the sidelines, the, $7-8 trillion in money markets, plus all the other cash and treasuries and so forth. There's a lot of money sitting on the sidelines on both balance sheets of consumers and really corporate America. I think that companies have also been preparing for recession, and it's showing up now in the jobs reports, right? So I think that going forward in 2026, there's going to be more of a fear of jobs and employment than inflation. I think inflation, really, the headline number may come down as we get more of the housing data into the current numbers as that's being reported throughout the year. And I'm hopeful that the Fed ends up cutting more than what's predicted by the market, which will, help equity prices.
Okay, so what would you say is driving the markets right now?
Well, I think it's going to be about fundamentals again. So I think that what is consensus is that analysts predict, that earnings are going to grow double digits, maybe 15% year over year, which is very high. Now, I think the tough part about that is that the expectations are going to be higher this year than they were last year. But margins are also expanding, and I think that's part of the secret sauce here, is that as the biggest input cost for profits, which is labor, is kind of holding steady because jobs have been slow. That's helping companies to increase margins, which they did last year. I think that story is going to continue to play out. Now, that being said, I think we're going to see a broadening out of what's been working in the market. So I think you can get follow through on small cap stocks, which have rallied this year past the technology and large cap stocks. I think you're also going to get follow through on international securities. So international markets, I think, are going to have another good year relative to the U.S. And so it's not going to be about the Max 7 anymore. As money comes off the sidelines, and a lot of people have missed this, bull market since the lows of 2022, including a lot of institutional investors. I think they're looking for value.
Okay, and you are favoring cyclicals right now along that same line.
We do, and so we think that cyclical sectors such as industrials, financials, materials, even consumer discretionary will participate, as we're not going to be in a recession. And if we do end up getting stimulus from more refund checks, from the big beautiful bill, and consumers will tend to spend that money, we think that that's going to be helpful. We know that the Fed's also doing a little bit of quantitative easing, as who knows if they're going to get a rate cut here in January or not. I tend to believe that we're going to get more rate cuts than what's predicted. That being said, I think there's more stimulus that's being put into the economy. And so I think that's going to be helpful for risk assets. And so we think that the cyclical sectors will do well.
Okay, so you touched on what you think could drive the markets higher this year. Are there one or two catalysts you're focused on that you think could really have that effect?
Well, geopolitical has been at the top of my list for a while now, and we're but we're continuing to see it rear its head again. And as investors are thinking that we're through the tariffs, and on the other end of that, in terms of what to expect and how that's going to affect company margins, you're seeing a lot of stuff come out of the White House in terms of rhetoric around tariffs, even depending on geopolitics, right? So geopolitics still continues to be very high for me. I think that we could get some animal spirits. So if we get the residential housing market to unlock, which is one of the things that I think would change consumer sentiment, I also believe that would really boost the economy and get a lot of other areas moving in the economy that aren't moving yet. But if the residential housing market unlocks, which means that mortgage rates have to come down significantly, and a lot more action happens in the residential housing market, we could get animal spirits, which could melt the stock market even higher to much higher parts of the range that we have for 2026. If that happens, I could see potentially a correction afterwards.
Are you looking outside of the U.S. at all, more internationally?
As I said, we do like international equities. We think that foreign markets present more value. I mean, it's always been the story for a number of years now that companies are a lot less expensive overseas than they are here in the U.S. We also have earnings expectations to be very good in the emerging markets as well. And so yes, we think that geopolitics will continue to be a concern, but we think international markets will have another good year. And I think a lot of U.S. investors are underweighted international. And so I think it's a good time for all investors to look underneath their hood and make sure that their global asset allocation is prudent.
Okay, are there certain countries you're looking at, certain regions you're looking at, certain sectors in those regions?
We do like, the Asian markets, and we also like some of the European markets too, though. But I think Asian markets are good. But overall, I think in general, overseas outside the U.S. Presents more value and has more earnings opportunity than maybe some of the more richer sectors in the United States. And so that being said, we also still like tech. I mean, tech we think is good to buy on the dips. Tech's not a sector that we would be negative on. And as we get mega cap tech earnings out this week and continuing on this quarter, we think that tech's going to continue to do well. We think that AI spend's not nearly close to being done yet. You're also going to see second and third derivatives of the AI spend come into play. And I think we're going to start to see, companies report productivity results from the AI spend. And as those results come in, it's really going to dictate, which companies that investors are going to favor.
Yeah, definitely will be watched closely as they start to report their earnings. Jimmy Lee, thanks for joining us. Appreciate your time.
Thank you.
Coming up, Northrop Grumman reported a higher fourth quarter profit and revenue driven by stronger sales in its aircraft business. More in a moment. Defense supplier Northrop Grumman saw higher fourth quarter profit and revenue driven by strong sales in its aircraft business with heightened geopolitical uncertainty. We got more from James Callahan. He's portfolio manager at Barometer Capital Management.
U.S. defense companies, the stars really have aligned for them lately. We've seen some massive tailwinds that maybe we can talk through, but specifically on the quarter, I thought very strong quarter. Stock traded off slightly in the pre, but is now, I see, back positive to start the day. If you had to nitpick two areas, I would say 2026 EPS guidance came in a little bit lower than expectations. That's why I wasn't surprised to see the stock trade off slightly in the pre. Their backlog growth was a little bit lighter than I would have wanted to see, but longer term, I wouldn't worry about this one. We like a lot of the U.S. defense names. Northrop Grumman is so strategically important to the U.S. and their nuclear efforts, now owning two legs of the U.S. nuclear triad. These are big programs. They're going to be generating a lot of profits for a long time to come. So those are the Sentinel ICBMs and the B-21 Raider, the strategic bomber. So very strategically important. As we see U.S. defense budgets move higher, it's going to be to Northrop Grumman's benefit.
So we're talking partially about nuclear weapons there.
Yeah, absolutely. I mean, both of these are very large projects and very important to the U.S. military and the country in general. So, that's against a backdrop of the president very vocally expressing his desire to bring U.S. defense budget up to $1.5 trillion by next year. That's up from just under $1 trillion right now. So over 50% growth. Normally, defense budgets don't grow by that much. So it's been to the benefit of a lot of these names. It's normally a sleepier space than I think people expect. Normally, these names don't actually trade very much. After reporting earnings, they trade on budget increases and contract wins and losses, that sort of thing. Mm-hmm. So it's been a good situation for them as the globe is more focused on defense spending.
And Northrop, is that a stock you guys are in right now?
No, we've owned it in the past. It's not one that we own right now. I like the look of it. But no, we focused in some other names like RTX, so formerly Raytheon. They also reported this morning very strong numbers, really good quarter. They beat top and bottom line as you would expect them to. CEO on the call highlighted the strength came from a handful of missile sales to NATO countries, as well as some Patriot missile system sales also. So that's a theme that's also benefited the defense companies. The U.S. defense companies are missile restocking. So over the course of the last few years, we've seen a lot of missiles and munitions expended. Those are all going to have to be replaced. Also, as we see more on the Golden Dome project, the North American missile defense project, which details are a little bit hazy right now, but we're learning more every day. It's going to be directly to Raytheon's benefit. They sell the Patriot missile. They sell various components into Israel's Iron Dome system that will also be used for Golden Dome. So it's hard to argue with the strength of the tailwinds that these names are experiencing.
The Boeing is not a name you own, but of course they have a gigantic defense business.
They do, and Boeing's been an interesting one. The chart has worked really well, and the stock's worked really well for the last number of months. It's not quite to the point where we would want to get involved, but they do have pretty good line of sight on a return to profitability this year. I think the discussion afterwards would be the reinstatement of the dividend, which would also be nice to see. But when you look at deliveries, which a lot is known for Boeing because they report deliveries monthly, plane deliveries troughed this quarter last year, so Q4 2024, with 57 planes. They're back to delivering 160 planes a quarter, and that's just going to grow from here. They've worked hand in hand with the regulators to sort out their issues, which were serious. So the stocks look pretty interesting. As I say, it's not one that we're owning right now, but it's on an upward trajectory, and it looks pretty interesting.
GM, what are your thoughts there? Is GM a stock that you're interested in?
Interested, I would say yes. We don't own it. Personally, it's been a bit of a head scratcher, I think, and a lot of the move has come because it's worked quite well actually over the last year, and it's worked well against a pretty bad auto market, which I think has been surprising. A lot of the move was associated with a regulatory change that came in the one big beautiful bill that was passed last year. They used to have to pay a fine every quarter because their fleet emissions were over a threshold. That was eliminated. And so that benefited GM to the tune of about $1 billion in pure profit a year. And from the results this morning, we're seeing that they're growing profitability elsewhere too, despite volumes being down, which historically is not good for auto manufacturers. Their mix is improving, so they're selling more of higher margin vehicles, and they're growing earnings. So we saw them, increase guidance for share buybacks and dividends today, which is great to see.
Oh, I forgot to ask you about one other defense stock, and I think you do like this one, General Dynamics, the maker of the Abrams tank.
Yeah, we own General Dynamics. We like General Dynamics more for the business jet exposure. So they also own Gulfstream. Okay. They wholly own Gulfstream. We own all of the business jet manufacturers right now. Actually, it's a good business jet market. So we own Embraer, and we own Bombardier in Canada as well. With actually a change that came in the One Beautiful Bill, U.S. companies and individuals are now allowed to accelerate depreciation on private jet purchases. You're allowed to fully depreciate the jet in the first year of purchase now. So the jet market's been very tight. These businesses are also growing their maintenance, repair, and overhaul businesses, which tend to come at much higher margins and helps to build backlog because they're signing service agreements. So we like all three of those names. General Dynamics, we'll see how they do tomorrow when they report, but all of those are names that we like and continue to own.
James Callahan is portfolio manager at Barometer Capital Management. And as you heard, GM did report earnings, so we'll dig more into the results and the guidance when we come back. Shares of General Motors rallied today. The automaker forecasting profit growth of as much as $2 billion and has increased dividends and buybacks. The move fueled by demand for new and pricier models. Our Bloomberg colleagues sat down with Mary Barra, chair and CEO of General Motors.
2025 was an exceptional year, especially when you look at all the challenges that we face. And I think it really demonstrates one of the core capabilities of GM, and it's our agility and our resilience. But the core of it starts with our great product portfolio, whether it's very affordable EVs like the Chevrolet Trax, all the way up to, a supercar like what's behind me with the Corvette ZR1X. So couldn't be more proud of the team.
The ZR1X with 1,250 horsepower. It is indeed, I would call it a hypercar, Mary. That's not the bread and butter, though, for you. You really make these highly profitable, highly capable big trucks, and Americans are buying more of those and fewer of the EVs. Do you expect to continue to sell fewer of the EVs? I know you took a $7 billion and change write-down for that business in 2025.
Well, the whole industry, we were on a path that we were working to get to 40 to 50% EVs by 2030. So now that the regulatory environment has changed and the consumer incentives have gone, there is going to be slower EV adoption. We're still committed to EVs, and we've got a great portfolio that we're working on taking costs out of. But in the meantime, we also have a great internal combustion engine platform. And you're right, full-size trucks are one of the strengths we have, as well as full-size SUVs, mid-size crossovers. So we really have a strong lineup across the board, and that is really what is, fueling our business success.
I have had, as the host of Hot Pursuit, a Bloomberg podcast about cars, the opportunity to drive a lot of your EVs, from the Sierra EV to the Hummer EV to the Escalade IQ, and they're fantastic products. Are you not deterred that Americans aren't buying more of these vehicles? You know how capable they are. You know how useful they are in daily life. What needs to happen for more Americans to buy these EVs?
Well, I think the consumer is very rational when they're making a decision about what car to buy. Let's remember, it's one of the most important and expensive decisions that they make. And one of the things we have to continue to work on to drive EV adoption is a more robust charging infrastructure. And that still is continuing to happen. So every quarter, more and more chargers are available. I think as people in their individual communities see that they've got a robust charging network and believe if they have to go on a road trip, there's that as well, they're going to make that choice. And what we do see is once someone someone buys an EV, they see the technology, they see the driving experience, never having to go to the gas station, and they stick with EVs. So I think it will happen over time, and that's why during this period we've already got a great portfolio of EVs. We're going to continue to take cost out to get our EV portfolio profitable, and we're going to be well positioned as EV demand grows over the next handful of years.
What about the hybrids, Mary? I mean, GM was really a front runner, not only in EV technology, but in hybrid technology with the Chevy Volt. I remember when the Tahoe came out with a 6-liter gas engine and electric battery power. Will you start to sell more of the hybrid vehicles?
Well, we have always focused. As you said, we have great hybrid technology. We have great EV technology. We're one of the few OEMs that invested in a dedicated EV platform that allows us to have the portfolio we have. So we're focused on the end game, and we have affordable EVs. So I think that's where our primary focus is. We understand the technology. We have it in other regions. You'll see us with a handful of hybrids as we move forward. But right now, our focus is really on having the right internal combustion engine portfolio and the right EV portfolio moving forward. And I think we're demonstrating that that's a winning formula, because over the last 4 years, we've gained share each year.
I wonder how much your racing efforts push towards that. And I know this is something I've talked about with your president, Mark Royce, on a number of occasions, but you're getting into so many more leagues. I watched the hypercars in Le Mans this summer, and looking forward to watching you participate in Formula One. Do you think this really boosts your brand awareness around the world?
Absolutely. We definitely see that it does. And I think, when you look at Cadillac and the strength of Cadillac, it is true luxury, true American luxury. F1 is the place that Cadillac should be showcased. So we're very proud to be a full works American team, anxious to enter this year in Australia. But I think it's going to be very important for the Cadillac brand. And we do have a really robust program that takes what we learn on the track and we incorporate it into our vehicles to make our vehicles better. It's true for Chevrolet as well as Cadillac and the entire portfolio.
I got to ask about the finance arm. GM Financial provided a massive liquidity buffer, I think $36 billion there. How do you think about, because you're doing buybacks, returning a lot of cash to shareholders, I'm sure they're happy about, the stock is near an all-time high, but how do you think about putting that aside for protection versus supporting shareholder returns, in case the auto cycle turns at some point?
Well, we've indicated that 18 to 20 billion is our cash target. Last year, we finished the year strong at around 22 billion. And we have a capital allocation framework of first reinvesting in the business, second, making sure that we have an investment-grade balance sheet, and then returning cash to shareholders. And we think based on the strength of our business and the cash that we generate, we can continue to do that well, and that's where our focus is.
The financial arm has added, I think, more than $2 billion to 2025 profits. So it's really a contributor, kind of a quiet profit stabilizer. Is that turning, though, as delinquencies and charge-offs rise a little bit? Is that starting to concern you as consumer balance sheets thin out?
Well, it's something that we watch very closely, but I think GMF does a great job in their business, and it is a very important business. Shout out to the GM Financial team for the great work they do. It's also very important from a loyalty perspective, because having a captive and being able to interface with the consumer on a monthly basis as they make their car payments, I think is just part of the ecosystem that we're building to really make sure we have that great relationship with the customer, and it shows that we have the highest loyalty in the U.S. of any OEM.
I look at loan originations in the fourth quarter, and I see that they're down pretty substantially, about 21%. And I wonder if that's a deliberate choice by GMF. Are you tightening your credit standards, or is that reflecting a softer demand at today's rates and prices, which are both fairly high?
Well, the car company and the finance company, they work together to make sure we have the right equation and what's going to optimize, profitability for the enterprise. And so I don't think you can look at one quarter. It goes up and down depending on what's happening in the external world. But GMF is a very important part of our portfolio of companies. And again, as I said, it works in concert with the car company to make sure that we have a strong business overall.
I have to, when I think of credit standards, I think of First Brands among some of the other businesses that have fallen to Chapter 11 this year. And I saw a report in the Financial Times overnight that you, along with Ford, your crosstown rivals, are negotiating to help send them a rescue line of sorts. Can you comment on that at all, Mary?
Well, what we're very much focused on is while we make sure we have secure supply is that transition period. So I think what you see General Motors and other OEMs working together to do is make sure that we don't have supply chain disruptions because of their financial situation. We've been working on it, but I think as we look at the immediate, what's happening next week, next month, that's the work that we're doing, as well as in parallel making sure we have longer term supply. So that's what you're seeing with that announcement.
When you talk about the supply chain, I think about the concessions you're able to get out of your suppliers. I know that you're trying to keep costs down. You're under a threat of tariffs, or you already face tariffs in a lot of the places you produce. How much of those tariffs have you been able to pass through to consumers where you haven't been able to cut costs or get concessions from suppliers?
I think if you look at our portfolio, I think, for the most part, we've worked to offset it and with efficiencies across the board, making smart decisions on where we produce. And so very little has gone to the consumer because we are such a cost-sensitive business, and it's such a competitive business. But we continue to look at all of those levers, and we stay focused on consumer affordability. You're operating, Mary, in the heart of America, and America's undergone some really tough times, especially over the last few weeks in Minnesota. What are you doing? What is General Motors doing to kind of keep the temperature down, to kind of keep the calm at your company and with your suppliers? Well, we want to make sure that everyone stays focused on the business and is part of the solution, meaning de-escalating. I believe that's starting to happen. So that's what we continue to reinforce.
Mary Barra is the chair and CEO, General Motors. Coming up next, the Federal Reserve rate decision tomorrow. What to expect when we come back. The U.S. Federal Reserve expected to maintain its benchmark interest rate at tomorrow's meeting, but it's likely the chair will be questioned about a legal case against him. Let's go to Dennis Lockhart, American economist, former CEO of the Federal Reserve Bank of Atlanta. Thanks for joining us today.
Thanks for having me on.
What's your take? Is the rate where it should be right now for the U.S.?
Yeah, I would be very surprised if there was a further cut tomorrow. I think they signaled in December that they're comfortable with the positioning of policy, probably for a few meetings even. They feel that they can wait and see how the economy evolves and obviously follow inflation as well as employment very closely. So I'd be very surprised if there was a further policy action tomorrow.
Do you feel that labor concerns have been put to rest, at least for now?
I'm sorry, I didn't get the question.
Do you feel labor concerns have been put to rest, at least for now?
Major concerns.
Labor concerns, labor concerns.
Labor concerns?
Yes.
I think the labor market is fairly static at the moment. Unemployment is at an acceptable level of 4.4%. It's been slowing in terms of job creation. Much of that job creation has been in healthcare. But at the same time, it's not unraveling. It's not falling apart. And people are basically maintaining their employment. Claims are low. So I think the overall assessment is the employment market is sufficiently healthy to go on hold for this meeting at least, and perhaps more.
What about inflation? Do you feel that inflation is in a range now where Americans aren't feeling too much pressure for prices?
No, I would not say that.
Okay.
We do have sort of a split economy. That's a bit simplistic, but split between affluent households and those households that are struggling month to month to get by, and that's a big portion of the population in the United States. And those people are feeling the cost of living and feeling the cost, particularly of housing and groceries. So it's not necessarily let's just say a single picture. The U.S. consumer continues to be quite active, and the consumer economy is going well. But I would not say that people can ignore the inflation rate that they're experiencing personally.
What about the threat of the government shutdown? What is your best guess on if one can be avoided, and how do you think that'll factor in later in the year, if there is one?
Well, I'm not following the play-by-play on Capitol Hill on this, but it is looming as a possibility. One recent article said it could be a partial shutdown, not a complete shutdown. We'll see how it plays out. But let me answer your question by saying it is one more factor in the first quarter of this year that will make it difficult, I think, for economists and for Fed staff to really evaluate the underlying strength of the first quarter economy. The first quarter is often a little bit odd because of weather and what they call residual seasonality. But if you add the possible shutdown to that, you could have a first quarter like last year that's weak, but then it's followed by strong quarters afterwards. So it's one more reason why I think the committee will be patient for a while before making any further policy decisions.
What commentary are you going to be listening for when you anticipate that there won't be a cut? What are you going to listen for from the chairman?
Well, the chairman's in all likelihood going to get a number of questions in the press conference about the Department of Justice investigation, maybe about the Lisa Cook proceedings at the Supreme Court last week. I think he's going to try his best to evade all those questions and say very little. And as regards the economy and policy, again, I'm not sure the committee is going to have a great deal to say. This could be, in some respects, a sort of boring meeting from the point of view of the public's public communication, because they are unlikely to cut rates. They're probably going to describe the economy as continuous with the fourth quarter of last year and reinforce the wait and see message. So I think there is not a great deal to say, and I wouldn't be surprised if that's the outcome tomorrow.
Okay, we will wait and see. Dennis Lockhart, thank you for joining us. Appreciate it.
Thank you so much.
The Prime Minister, Mark Carney, is denying claims that he retracted his remarks from Davos during a follow-up conversation with the U.S. President Donald Trump on Monday. More in a moment. The U.S. president has threatened 100% tariffs on Canada, but our prime minister and the American leader did speak on the phone on Monday to sort out their issues. Let's go to John Weeks on this, member of the expert group on Canada-U.S. relations. Thanks for joining us today.
Thank you very much, Marilla.
Did you take those new tariff threats seriously?
No, not really. I must say, I think if you take everything Donald Trump says seriously, you'd become a very poor sleeper.
Okay, we know that, or it sounds like Donald Trump took the remarks by our prime minister at Davos quite seriously, or at least to heart, which may have prompted him to threaten that tariff. And I'm wondering what that fine line would be for Carney, where he says he didn't walk back what he said, but he still needs to have the president work with him.
Well, I think the fundamentals are that were really laid out by the prime minister in his speech in Davos. And I think going forward with the United States, we hope we'll be able to successfully conclude a good review of the NAFTA, which will lead to its continuation for a number of years. But I think it's to make that should not be the only goal we're trying to seek. Given the uncertainty that Donald Trump has created, I think it's critical that we go ahead with the program that's been identified for the government for strengthening the Canadian economy and diversifying trade relations. And frankly, diversifying trade is in some senses a goal, but we won't get there without strengthening our economy and beginning to really produce things that the world wants. We do have things that the world wants, but they're largely in the ground. And we're going to have to figure out how to make our economy more active, how to make it more dynamic, and how to actually begin to produce things again.
Okay, let me ask you first if you think there's any merit to American concerns that Canada becomes a dumping ground for Chinese goods that then make their way into the U.S. This is one of the allegations from the U.S. Since Canada has signed, or at least come to an agreement with China on reducing tariffs.
I often think it's a mistake to try and parse Donald Trump's tweets, but in this case, given that he's threatening 100% tariffs, I think it's probably a good idea to look at it quite carefully. And you've just identified the fact that he talked about Canada as he calls it Trump called it in his post a drop-off port for China to send goods and products to the United States. And quite clearly, what was agreed with China a couple of weeks ago is not anything that would allow that to happen. And in fact, any Chinese goods which come into Canada aren't going to go on to the United States unless they get through the United States customs. And to do that, they're going to have to demonstrate that they comply with the rules of origin of the Canada-United States-Mexico agreement, the CUSMA. So So there's no threat here of products coming in under the tariff deal we've just done with the Chinese that are then going to go on into the U.S. market. It's just not going to happen. It's not real. So in a sense, if he predicates his remarks on that, then we can already begin to relax a bit because that's not going to happen. And then, of course, he conditions the 100% on if Canada makes a deal with China. And I think in Trump parlance, a deal isn't just changing a few tariffs. A deal is really something more like a free trade agreement. And quite clearly, the Prime Minister has said, we have no intention of negotiating a free trade agreement with China. And I think that's probably absolutely correct, not for any very long foreseeable future.
Yeah, so that was the interpretation of Ottawa, as you mentioned. But Canada is now talking about sending more energy products to India. One of our team, we have a team there now. Of course, the China agreement. I'm wondering whether you think Canada is partnering with the right nations on this path to diversification.
Well, I think it's very, very hard to decide in commercial transactions who you're going to partner with, especially if you have an objective of diversifying your trade and trying to increase exports to countries other than the United States by 50% over 10 years. I think we have to do it as the Prime Minister said. We're going to have to take the world as it is and not as we would wish it to be. Of course, we're not going to do things that are going to damage international security, but I don't think we will sit down and do a moral profile of all of our trading partners before we decide whether we want to export to them.
You touched on CUSMA renegotiations supposed to happen this year. Do you think we are headed for a new deal or bilateral agreements with the USA and Mexico?
Well, I think, a lot of people are talking about the deadline of July 1, as if, everything had to be decided by July 1. But under the agreement, July 1 is the date for the start of the review process, the formal review process. And so, and part of that review process has to be a discussion about whether or not the parties wish to extend the agreement for a further 16-year period. And if they don't reach agreement on this, in the course of, the review process, however that long lasts, then they don't, and they decide not to extend the agreement then, well, it goes on for another 10 years until it expires. So there's lots of time to have further discussion about how to continue the agreement. And in fact, the agreement itself provides for a review every year if the first year's review isn't successful.
Okay.
So this agreement is in force until 2036.
All right.
Unless the Americans decide to use withdrawal clause
Okay.
and leave the agreement.
I have to interrupt. I'm sorry, we're just run out of time, John, but
right.
I do appreciate you joining us on the topic. Thanks for that.
You're most welcome.
That does it for the close today. Thank you for joining us. We'll see you back here tomorrow.